Reports of Russian military returning to their base camps stabilized forex markets yesterday, allowing the Indian rupee to rise for the first time in 6 days. The Indian currency settled at 75.33 per US dollar mark on Tuesday, but continued to hover around 6-week low levels. It touched 75.64 per dollar mark on Monday, its lowest level in 2022. According to media reports, Russian Defense Ministry has said that military units from the southern and western districts of Russia have begun returning to their garrisons, a move that could de-escalate the febrile standoff between Russia and the West over Ukraine. The developments comforted investors who lost trillions of rupees in wealth due to Monday's market rout. The S&P BSE Sensex titled 1736 points higher at 58,142, while the Nifty 50 ended above 17,350 mark. In the commodities market, Brent crude futures slumped 2.4% to trade around $94 per barrel mark. This sharp drop in crude oil futures eased the demand for greenback in currency markets, alleviating pressures on the rupee too. But the rupee-dollar trajectory will likely remain volatile in the near term till there is a definitive agreement between Ukraine and Russia. Besides, multi-year high inflation across global economies, along with a dovish RBI policy, is expected to keep dollar demand pumped up in the markets. According to Julius Baer economist Sophie Altamart, we expect the USD INR to rise around 76 in the next 3 months as India's monetary policy normalisation is delayed in a global context and high commodity prices are weighing on India's trade balance and will widen the current account deficit further. Moreover, the prospects for Indian government bonds to be included in global bond indices in 2022, which would provide indirect support for the rupee over the medium to longer term, have diminished. Vivek Kumar, who is economist at Quantico Research, too believes the rupee may reach 76 to 77 per dollar over the next 3 months as a sharp rate hike cycle in the US will support dollar bulls. Trade normalization post-pandemic, increased pace of vaccination, volatility in crude oil prices, and uneven foreign fund flow could also put pressure on imports. This, he says, will widen the trade deficit account in fiscal year 2022-23. Though over the next fiscal year, he expects the rupee to stabilize and see lesser volatile moves in FY23.
In FY22, the estimate is that the BOP surplus could be somewhere close to $43 billion after you adjust the special SDR transfer which the IMF did. For FY23, our estimates suggest that the BOP surplus could fall down to single digits. Now that's a big evaporation of support to rupee, and this is likely to come about at a time when the dollar sentiment is extremely positive. So the depreciation bias could continue in the near term at least. However, at the same time, we would not expect a runaway depreciation pressure on rupee. In fact, the volatility could remain subdued. Reason being, the insurance cover which the FX reserves provide is extremely comfortable right now. Vis-a-vis the previous taper tantrum episode in 2013, our FX reserves provide you a cover of 14 months of merchandise import. That is after including the forward reserves as well. Now, this would be almost double of what we were in the year 2013. The other aspect to look at is that growth inflation balance sequentially is getting better after the setback in 2020. For the year FY23, the consensus estimate would be somewhere close to 8% on GDP and 5% on CPI inflation. Now, most of the other countries in the world on the growth metric would be below India. So India probably would be one of the most fastest growing economies in the world. And as far as inflation is concerned, the deviation from the target is something which is pretty moderate. This again is in stark contrast to what we are seeing in most other countries where the deviation from target is sizable. So the macroeconomic balance is better, the reserve cover is sufficient enough to provide or to guard against any unwanted volatility, and that will help in curtailing any bit of runaway pressure on rupee.
Overall, geopolitical developments, crude oil prices, and reversal in low interest rate regime will guide the currency markets over the next few months as the actual impact of these events is yet to be fully priced in by the markets. As regards today, market participants will monitor developments along the Ukrainian border and their impact on commodity prices. Back home, stock-specific news flow and listing of Vedant Fashions will be tracked by the markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.